Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So today was probably the first potent down day we've had in a while after an enormous run. We've tried to put as much in perspective as possible. You know, one of my notes was don't be spoiled. One of them was don't fall asleep behind the wheel, you know, etc. Blah, blah, blah. It's still even hard for me, you know, when you get caught up in situations and stocks still look good and you're still seeing some rotations, it's really easy to lose money because we're not going to be perfect. Okay, we're not going to be able to just buy at the exact right time and sell at the exact right time. We could do that quite often, but if you're looking to take a portfolio approach, you're looking to scale things and try and take action or hold for a move and let the market make you some money, you're going to have some down days and you're going to have to deal with it. And at this particular point, just know what you can deal with. Thursday's off the charts. We talked about selling into this 1280, 1290. That will at least see, you know, 1255 in the next 3 to 5 sessions, and that was Thursday into Friday. And then today, we talked retracement rules with Alex. We talked about the 25% retracement rule, meaning that super duper duper duper, how many dupers was that? 4 hold their 25% retracement. Usually it's not even something spoken about, but it's in the, it's actually a tool within that retracement because sometimes it happens, and that did hold the entire rally, which was why it was so fast and so furious, because that means you never really pulled in, they never let shorts roll themselves out, and you had to buy quickly. And that's the 25%. A strong market still holds the 38.2. That's what normal people talk about. Normally, that's the area that if it holds, that shows commitment, that shows buying, that shows you that things can go further. So a lot of people were begging to buy it today. I was getting hit up on my IM everywhere. What can I buy? When can I buy? Just like, you know what? Nobody wanted to buy in the past few weeks, you know, when the pull-ins were really shallow. Now everyone wants to buy because they got squeezed out. It could be a bit trickier. We also talked about why would they run into Wednesday's Fed announcement why would Ben Bernanke be so accommodating or throw some more biscuits or sugar at the market if we're above 1,300? It might have a little bit more of a supportive type tone if we're back at 1,250 or back at 1,240. Anyway, look at the chart of the S&P. This is what we went over this morning. This was your rally into this prior resistance, obviously taking out this one. We opened below the 200-day moving average, so right away that negated the strength or anything just worth looking at there. And then we wound up closing on our lows. We sort of matched that high. Remember that high of about 1256, which took place before this little mini down move to retest this 1220. And then we took off. So right now we closed near this, okay, which is a point of reference. So I would say I talked about this 1256 as being a point to talk about. And who knows, maybe they gap up the market tomorrow and trap any of these bears, but I don't think you have to really worry about that. But the 25% retracement, meaning the pull-in from the low of 1074-ish to the high of 1293 stands at 1240. Now when I was writing that, or I sent it, it looked like it was far away, like 124. I'm like, 124. I'm like, I'm having a hard time staying short at 127, and I'm like, that's 3 points. So I think we closed at what price? I think we closed around 126 or 125.40. Actually, where did we close on the spiders? Let's take a quick look. Spiders closed at 125.50. So if you look here, this is what we drew. This was the level. So why would people want to be buying on this? It's just you know, I understand this was fast and furious this whole way up, but this from this upper resistance, your first way down, okay, your first big bar, why put yourself at that risk when we could at least hit 124, and there's might even a shot that we hit this 121. This is the 38.2 retracement. If you remember, this was that small little wedge that we drew right here as we held. Remember, you know, here was your 1220. And then we had this small wedge here, and this could be tested at some point, okay? But we'll see if we and then we could test this, and even, I hate to say it and sound crazy, and even still make new highs in the year, but it would be done at a different rate. There would be a different type of trade, and that's what we have to measure, the different types of trades. You know, today they gave you a way out of a few stocks. They brought Deckers positive, Under Armour positive, Lulu positive. They squeezed Amazon through Friday's high before it did that red dog reversal and came in. You know, Apple, they gave you a way out. They actually even paid you a little bit to buy strength before it failed at that 409 again. The banks just never gave you a way out. The banks with the MF news, it just hit the banks really hard. And now if you take a quick look at the XLF, you'll see this is way into this gap already. But look where it came from. So as ugly as everyone's saying the banks looked with MF declaring bankruptcy, all you had is a wide range bar to negate this upper flag. So now the question is, you could do the same thing here with these Fibonacci retracements. And the banks didn't hold 25. They held 38.2 or 32, whatever that number was. Yeah, 38.2. So we're getting close to the 25% right here. That's 1338. We'll probably open there tomorrow. So this might not be the level that holds because the banks have always been the weak spot. So it could be that the 1295, and this actually will correlate to this last previous breakout at 1295. So right around 13, I would think is a good spot to look to buy the banks back. I held the banks for a week or so, and I think I sold it on Thursday also, not knowing that it would be the top, just knowing that we're coming into a pretty big resistance area, another moving average, big move off the lows, so worth selling. So here would be 25% if it starts breaking. What's important about that is then you know that something is breaking and showing relative weakness ahead of other things. And then maybe the OIHs do it or the XLI, or maybe they don't. So then this way we know when we do find our footing, if we find our footing, because the market will tell us that, then we'll know which sector to go to where the most opportunities will be. If you look at Goldman Sachs, I talked about the gap at 110. Well, it's there, okay? And it's still fine considering, look where it went to look at this resistance. This was buy 1, buy 2, and now it's going to fill this gap. I drew this morning. We'll see how it handles. If it opens up tomorrow a little bit, trades through today's low, perhaps you short it. Maybe it fills a big portion, comes back up, and then you get an 80-20 trade. So we'll see how that trade changes. But not a bad idea to be taking some trades off in Goldman after a move from 85-ish all the way up to 120. Nice little sideways action would be healthy even down here. And I guess there's a small chance even down here. If you want to do this quick fib here on Goldman, it went as high as 118-ish. So the 25% retracement is right at the gap, 109.65. And then the 38.2 is right around this 105, which would be about the gap fill, which could happen. So this is an interesting zone to buy back, not here, not when the banks are the weakest sector, not when the banks just had a big move, not when MF just declared bankruptcy, but maybe into here, makes sense. And then obviously the 50% is really just the don't pass line, and that was the last viable strategy that came in right around here. Actually, it's a little bit lower than that. But anyway, we'll cross that bridge when we get there. As far as, let's look at the OHs. What did they do today? The OHs, if you take a quick look at the chart, you'll see it engulfed this upper range like most other things, heading into the gap, and 122, why not, right? From 100 to 134, or actually below 100, the red dog reversal happened at around this 95 to, actually, the low here was, like 99.45, so nice move. Everyone's crying, one down day, oh my goodness, the rally's over, risk off. No, big move, one day down, have big support over here, doesn't mean risk off. It means you trade around your positions. If we have 14 to 16% move in the indices off the lows, you're allowed to sell some. Stocks have had a 15 to 40% move off those lows, some even more. You're allowed to sell some. So just because it's the first down day doesn't mean it's over, risk off, and go close your books up and go in hibernation for the winter, or wake the bears up and take them out. There's a lot more to it, but don't get caught up. And it's hard because I wanted to be flat Friday, and I got sucked into 4 or 5 charts that looked good, and some of them gave you no way out. LinkedIn was a piece of junk. LinkedIn opened down $3, and you couldn't salvage that trade. Sometimes you get a good setup. You look at LinkedIn, was a decent setup, right? And it's still, I guess, okay. It's still holding. You don't want to see it negate this, but it just opened down and didn't give you a way out at all. So I actually got stopped out. If you look here, you had a big gap down, went sideways, and then I'm a little uncommitted to this stock, so I had to sell it right when it broke to the downside there. Okay, whereas some stocks like Apple gave us a way out. Apple opened down, right? Good stock. That's why I love trading Apple, because sometimes you do get a way out. Went sideways, flagged, and then you could have either bought right here, or I think I added to my position right when it looked like it was heading into that gap. And then if you miss this, it traded above the high from Friday, and then once you didn't get a pull in, you had a nice bull flag right here, showing you commitment at this upper level. huge move off the lows. You didn't believe in it. You didn't want to do anything with it and play the gap fill trade, which I love doing. Went up into resistance, held higher. You could have bought it right here and then bought it over the morning high and still had a nice trade. And then it just ran out of gas. And I don't think I did much with it. I think I had a little bit left long, and I got stopped out perhaps right around here, right when it broke back below this 106.50-ish. And then it closed relatively strong for the market. But at this point, this has been really, really choppy. But at least if you took it home long thinking you might get a powerful trade into the gap, which is what I was thinking, you had a way out. It was down $3. It didn't just open down 3 and go down 8 like Google. That's why it's so frustrating. I took that home also. Opened down like 5 and didn't like open up down 5 and then try and fill the gap and then fell. It just opened down 5 and went down 8 and we did the same thing Google's been doing, which is just horrible to trade. If you look at close near the low, it's still hanging around. It's just so frustrating to trade because it's so expensive. It's hard to trust. It's easy to lose. So now, if you want to compartmentalize this somewhat, here's your upper range. It's still in the top end of it, and knowing Google could turn up tomorrow, and we might be buying 602. But I just got myself out because it could just as easily go to the bottom end of the range. So losing a little bit of edge there. As far as Amazon, it goes to show you how you could trade stocks off their lows and you can get little combustible patterns. Like with Amazon, you had a bad earnings report. It went to the 200-day. People who were trying to short it and were pushing it through there, they were trapped short. So when it went into the gap, it's always tricky. That's why people like to play gaps because there's a lot of unknown there. So Friday was your great gap trade, right? It went above 208. And then today, it was a little tricky. There was still some shorts trapped that said, oh, Amazon bad earnings. I'll give myself to today's high as a stop. And then it triggered through there, squeezed a short. Some people who chased it said, you know what, maybe it might go to 220 or so. And then they got caught. And then once it traded back below Friday's high, that trade is over. Now it needs a lot of time. It's back in the penalty box. But that's a strategy we could use. If you take a look here, you'll see this was the short-term cash flow buy as it goes in the gap, and then pushed up a little bit, tried to get above, or went above this really quickly, above this 218.40, and then just ran out of gas. And I think it's not even worth a look until it tries to get back down to this 210. Obviously, it's got to get through today's low first. So just a little trades to do if you're a professional. As far as being an investor in Amazon, you're in the penalty box, and you've probably owned it for a long time if you're just an investor in Amazon, so you have some room. Perhaps sell some in the money calls if if it doesn't fill that gap and it starts to turn, just be careful. As far as what came up, Dunkin' Donuts, DN, what is it, DNKN, Dunkin', looks pretty good. Typically, you get the biggest runners or the biggest appreciation equity scenarios, stocks that were new issues that have a good story, both ways, and have small floats and tightly held. And this right now, it was trying to get above this 30. It might need a little bit more time, but you now have about 3 to 4 months of institutional ownership, exchanging hands. You're getting some people involved here. So if this were to get above 30, and then you have the high from the IPO of about, 32-ish, it could see higher prices in the next year or so. This is one of those stocks that I think you could put in your portfolio if you're not a trader and maybe buy just say 29. Look at one more time, put a stop in around 26. So maybe you have a 3-point stop because the trade would change and technically get weak again if it were to break, in my opinion, this little uptrend. Okay, it hasn't done that in a while. So if it were to break back below 27, I think the trade's off the table for now. But if it holds this 27, it looks like it could make a move. So if you're looking for another go-to stock, another stock that could be at new highs, whether it's this quarter or next year, this looks pretty good. Starbucks has been an unbelievable winner for people who were involved the first year or then some. Look at Starbucks. I know lately just hit a new 52-week high. It's kind of sloppy up here for now. I'm not going to say there's much opportunity here. I guess it's an ascending channel, so you have to be a little careful if it resolves to the downside. But more in the story of Dunkin' Donuts, look at the monthly chart. It's been an unbelievable move from 10 to 45, and then you go back even longer term. It's at historic highs. Paying investors came public back in '93. Okay, so anyway, with all that said, Dunkin' Donuts is a candidate. I'm not in it. I'm not looking at it really that much, but it was brought to my attention, and for some reason I was thinking about it. Maybe because on Saturday I did go and grab a big Dunkin' Donuts iced coffee, and I was a little upset that they canceled the twists. The twists were really good. The salt twists, those, instead of the bagel, better than the bagels. The bagels at Dunkin' Donuts aren't that good, just the iced coffee. But anyway, I was there and I happened to think about, oh, what happened? How's Dunkin' Donuts holding up? I haven't traded it really since the IPO, and the chart looks okay. As far as GE guys were asking me about it, here was your move. This was the tight pattern. That's why it was nice to trade when tight patterns are tight patterns. They work out well. Big move up, inside day, filling the gap. If you are a believer in the long-term story of GE, or you're looking to put some capital work, perhaps you could buy back here. For me, it was a trade. And I guess if I want to re-put on 8 to 12 positions, this is a candidate to be one of them. I'm not sure the approach I'm going to take when we get to 1240, so to speak, if I'm going to want to have the stress of holding 8 to 12 positions, managing them every day, coming in, worrying about all the headlines, or just hit and miss and make cash flow and tack on a month. That's really, I've been switching off back and forth based on the chart pattern each time, so we'll cross each one of those bridges when we get there. So the bottom line is, MF went bankrupt today, and I hate to say it because obviously there's the human side of it. There are a lot of traders out of jobs, and that would suck if ABN AMRO or Lightspeed or something happened with one of those guys and we weren't in control of it, but like a lot of the traders there. But I think what's also good is that they let it go bankrupt, right? Our whole banking system is horrendous right now because they spent $28 for Merrill Lynch instead of $1 the next day. They came in and propped up every bank and joined them together and made strong banks into weak banks because they wanted to protect some of the bondholders and some of the forces of will. So with MF, maybe they wanted to protect the bondholders from 4 or 5 months ago that I think it was a $350 million bond offering, but then there's no negotiation, everyone's whole. So this way, strong clearing firms or strong brokerage firms or prime they're going to come in and they're going to get the strong assets, and it's unfortunate that company had to go down, but stronger companies will get it on the mend. Versus someone coming in and being forced to say, let's just take MF, buy him out at 4 just so we could give them time to solve all the problems. No, that's how you weaken everyone. Same with the countries. These strong sovereign nations keep supporting the weaker ones, and they're all going to become a mishmash of weak European countries that are probably going to take 5 years or so to get back on their feet. Obviously, they're trying to prevent the calamity, and I don't know. It's Halloween. I'm getting into this whole discussion here, but anyway. Sorry, it's 425. I got to catch a 445. I am short a little bit of the spiders still. I got out of most of my size. They stopped me out of lunch when I was studying for the 24. And I was stopped out of some of my other longs. So I would just clean up, be a little tight. I think we could have this type of trade going into Wednesday, which is Fed Day. I think we have some retracement levels that are now going to become a bit more compelling now that they took some of the fluff out of this move. They punished some of the chasers from last week, and also some of the shorts that finally capitulated into that European news Thursday, Friday. They're like, oh my goodness, I can't believe I get covered. So there's going to be a good dynamic of opportunity, but as long as you have the plan and you're not just caught up in it, because it's really easy. You saw that even with us. On Friday, we got a little caught up in things that look good, knowing that it's time for a bit of a retracement. So as long as you don't turn that into a stubborn cost average mess, you're fine. If you get a bad hand, you trade out of it. Out of the 5 stocks I think we were in overnight, 4 of them went positive and you could trade it out of them. Like TZU actually went positive and pushed. Apple went positive and pushed. LinkedIn and Google kind of had to cut your loss if you were trading it with me. And what was the other one that I had? Oh, I was short spiders, which was great, which served its purpose because it helped mute some of my longs because it was the maneuvering ability before getting net short at lunch. So I've babbled. I don't know, long Monday already, big test Thursday. We'll get through it, you'll get through it, and there'll be a lot of opportunities. Scott Redler, T3 Live, the recap. See you on the morning call with Alex and Jill for Options Profits. Have a good night.